Good morning, everyone. I'm Tony. Today, I want to give you guys a brief on the topic risk calculation and lot size calculations. Now, most people enter trades without knowing the lot sizes to use for their risk and for their account size. Most people over leverage their accounts. Most people use lot sizes that's not applicable to the stop loss they are using. Now, before you enter a trade, you should already preconceive your risk. You know the amount you are risking and the loss sizes applicable to that amount you are risking. For example, this is how I calculate my risk, me personally. Now, there's what we call unit of measurements of currency pairs. For example, like JPY pairs like Euro JPY, GBP JPY, USD JPY, they have this calculation unit of 6.65, and GBP USD, Euro USD pairs, gold like ZAR USD, they have calculation unit of 10. Get then for GBP AUD, Euro AUD, USD card, they have calculation unit of 6.65, same as GBP JPY. There's a better way or an easier way to know these calculation units. If you use Xness, you can just go to your Xness broker, try placing a trade, then impute one lot size. Down there that they wrote Pip's profit, that's the unit of calculation. And it means how much you are making in USD per Pip movement of one lot size. That's what I use in my calculation. So any pair you want to trade, you can just go to Xness, search the pair, try to place whether a sell or a buy, anyone, then impute one lot there and check Pip's profit. That's going to tell you what the unit of calculation is. So GBP JPY, Euro JPY is 6.65, GBP AUD, Euro AUD same 6.65, GBP USD, Euro USD, ZAR USD is 10. So depending on the pair, there are different calculation units for it. So this is what I do. Let's say I want to risk $100 for a particular trade. What I do first is I know I'm risking $100. I do $100 divided by that unit of calculation for that pair. So if it's GBP JPY, I do $100 divided by 6.65. The 6.65 being the measurement unit for GBP JPY. You understand? You can get that from going to Xness, trying to place a trade, put one lot size and check the Pip's profit there. So I do $100 divided by 6.65. Whatever I get, I then divide it with the stop loss in Pips of that particular trade. So if my stop loss is 15 Pips and I want to risk $100, I do $100 divided by 6.65. That will give you 15. Then I do that 15 divided by the stop loss in Pips. Let's say I'm risking 15 Pips. I do 15 divided by 15. That is one lot size for that particular trade. Remember, I said the amount you want to risk. So let's say I'm risking $100. $100 divided by the calculation unit of that pair. So $100 divided by for GBP JPY is 6.65. So $100 divided by 6.65, you get 15.03. 15.03 divided by the stop loss in Pips. So let's assume it's 15 Pips stop loss. So 15 divided by 15, you get one lot size. That means if you use one lot size and 15 Pips stop loss is to hit on GBP JPY, you will lose exactly $100. If it's GBP USD, the calculation unit for GBP USD is 10. So if it's $100 I want to risk, I'll do $100 divided by 10. 10 being the unit of calculation for GBP USD. So $100 that I want to risk divided by the unit of calculation, that is 10. $100 divided by 10 will give you 10. Then I will divide it with the stop loss in Pips. So let's assume I'm risking 15 Pips stop loss. I'll do 10 divided by 15. That will give me 0.67 lot size. That means if I risk $100, that means if I use 0.67 lot size and trade GBP USD and my stop loss hits, that is 15 P stop loss, I will lose exactly $100. So with this, I go into a trade knowing exactly how much I'm willing to risk on this trade. If I go into this trade, I know that I'm willing to risk this amount of money. I calculate the lot size that I'm supposed to use. It means I won't be taken out of this trade unless my stop loss hits. Understand? So for people that fund the amount of money they are willing to risk on a trade, you fund it, calculate the losses you're supposed to use depending on how many pips your stop loss is. And once that stop loss hits, that's when your account will be taken out, to avoid trades taking you out and then moving in your direction later on, because you didn't calculate exactly when you will be stopped out and the stop loss you're supposed to use. Understand? So in this way you don't over leverage your account. You know exactly how much you're risking. For example, if you're someone that deals with good risk management and money management, if you have $1,000 and you decide to risk 10% of it, you know you're risking $100. You calculate how much you're supposed to risk for that $100 for you to only lose $100 if your stop loss is to hit. If you want to risk only 5%, that's $50. You decide to calculate the losses you're supposed to use, that if your stop loss you hit, you are only losing the amount of money you intended to lose in the first place.